If your car died tomorrow, would it be an inconvenience or a full-blown financial emergency? Before we start, when I say savings, I mean the money you've set aside on purpose, cash for emergencies, plus longer-term investments for future you. Those are different tools for different problems, and the milestone you're at changes what peace of mind actually feels like. Now, let's walk through what life tends to look like as your savings ladder climbs, one milestone at a time, and what to do at each rung so you don't just look rich on paper, but feel safe in real life. The $1,000 shield, $1,000 isn't wealthy. It's not fragile. It's the moment you stop living one random bill away from chaos. Tire blows. You need a last-minute flight. The dog gets sick. With $1,000, you're not forced into panic decisions, like choosing the credit card because you have no other option. Here's why this matters more than people admit. The Federal Reserve tracks a simple question. Could you cover a $400 emergency with cash or the cash equivalent? In 2024, only 63% of US adults said yes. That means a huge chunk of people are still in the danger zone where a small surprise becomes a big problem. So what does your life look like at $1,000? You sleep a little deeper. You can fix something quickly instead of waiting until it breaks worse. You can say, "I've got it," without borrowing from family or putting it on plastic. But the real power move at this level isn't the number. It's the system. Pick one boring place to park this money. A savings account at an insured bank or credit union, and label it mentally as untouchable unless it's genuinely urgent. Not a sale, not a weekend trip. Urgent. And do this one thing that feels silly until it works. Make the goal small enough to start today. $5 a day is $150 a month. $25 a week is $1,300 in a year. Your first milestone isn't having $1,000. It's proving you can consistently keep money. Once you've got that skill, the zeros get easier. And because I know someone is thinking it, yes, you can invest later. Right now, you're buying stability. Next rung is where things get interesting because it's the first time money stops being only a safety net and starts becoming leverage. The $10,000 breathing room at $10,000. You don't just have an emergency fund. You have time. Time to compare quotes instead of taking the first mechanic who can see you today. Time to wait 2 weeks for a better job offer. Time to handle a medical deductible without turning it into a debt spiral. This is also where your brain changes. When you have a buffer, you make better decisions because you're not constantly in fight or flight mode. There's evidence for that, by the way. Vanguard has research linking emergency savings levels to higher measured financial well-being scores and lower financial stress. You're not imagining the relief, there's data behind it. So what does life look like here? You stop using your future to pay for your present. You break the "I'll figure it out later" cycle. And you can start asking a new question. What problems can I prevent instead of just surviving? Because at $10,000, prevention becomes cheaper than repair. One practical rule you'll hear often is to aim, over time, for 3 to 6 months of essential expenses in cash for emergencies. That guideline shows up again and again across major personal finance educators and firms. Is it always exactly 3 to 6 months? No. If you're self-employed, have irregular income, or have dependents, your right number can be higher. But $10,000 is the first milestone where that conversation becomes real, not hypothetical. And here's a mini reality check. $10,000 is still not safe forever. It's safe long enough to make a good move, which brings us to a milestone hardly anyone talks about, but it's secretly one of the most powerful. The $25,000 buffer at $25,000. You're not just catching emergencies, you're absorbing them. This is the stage where one bad month doesn't wreck the next 6 months. If you've ever had 2 surprises back to back, car repair plus a sick week plus a rent increase, you know how brutal stacked problems can be. $25,000 is what stops the stack from turning into a collapse. This is also where you can start separating your savings into buckets, because not every dollar should have the same job. Bucket 1, emergency cash. Bucket 2, near-term goals in the next 1 to 3 years. Bucket 3, long-term investing. Why split it up? Because the moment you invest money you might need next month, you risk having to sell at the worst possible time. And markets do not care about your timing. If you want a picture in your head, think of your money like weights in a gym. Your emergency fund is the 10-pound dumbbell you can grab instantly. Your long-term investments are the heavier weights, powerful for building strength, terrible for sprinting across the room during an emergency. At $25,000, life often feels like this. You're still driving the same car, living in the same place, wearing the same clothes, but your stress level is noticeably lower. That's because you're quietly buying back choices. And if you're still working your way up, please hear this. The milestone isn't having $25,000. The milestone is having $25,000 that you don't keep respending. So you need automation, not motivation. Set a weekly or payday transfer so it happens without you. Motivation fades. Systems don't. Now, the next milestone is where the compounding story starts to feel real. Not in theory, in your actual life. The $100,000 breakthrough $100,000 is where money starts behaving like a teammate. Is $100,000 enough to retire? Not for most people, but it is enough to make progress visible. Here's the shift. When your savings are mostly cash, growth is slow. When a meaningful portion is invested for the long term, growth can start to compound on itself because you're earning returns on previous returns. Even small percentages become meaningful when the base is bigger. This is also where boring things like fees matter. A tiny difference in costs is barely noticeable on $1,000, but it's very real on $100,000 over many years. That's one reason index funds exist. They seek to track an index rather than pay teams to pick stocks, which can reduce fund management costs. So what does your life look like at $100,000? You can take a calculated risk. Switching careers, going back to school part-time, relocating for a better opportunity, or starting a business with a longer runway. You might still feel anxious because $100,000 is not a magic shield, but you're no longer trapped. And here's the part people miss. If you get to $100,000 by grinding and then stop paying attention, you can still lose the plot. You need guardrails. One of the best guardrails is a simple asset allocation. Decide how much is in stocks, bonds, and cash, based on your time horizon and your ability to stomach volatility. The U.S. Securities and Exchange Commission explains that asset allocation means dividing a portfolio among different asset categories, and that the mix depends largely on your time horizon and your ability to tolerate risk. So if you need the money in 3 years, don't pretend you have a 30-year stomach. Build a plan you can hold through a scary headline without touching the sell button. Usually, the plan that works feels a little boring, and boring is repeatable. Stay invested. Compounding eventually does the heavy lifting for you. That means an emergency fund you can access immediately. It means spreading risk rather than betting everything on one stock, one crypto, one hot idea, or one employer's shares. Diversification is boring. Right up until it saves you. It also means using the benefits that are literally designed to help you build wealth. If your employer offers a retirement plan with a match, that match is an extra contribution tied to what you put in. Leaving it on the table is like walking past money with your name on it. Now, if $100,000 is the breakthrough, the next band is where the flywheel gets heavy, and life gets oddly quiet. The $500,000 flywheel somewhere between $250,000 and $500,000, your money starts showing up even when you didn't do anything new that month. This is where compounding starts whispering instead of shouting. One month you look at your account and think, wait, did it move that much without me? And that's the point. Progress becomes less about heroic effort and more about consistency and staying invested through boring times. Now, here's something practical that changes at this level. Where you keep the money matters. Cash for emergencies is great, but large cash piles can create a new risk, concentration in one institution. In the U.S., bank deposits are typically insured up to $250,000 per depositor, per insured bank, for each ownership category under FDIC rules. So once your cash is getting big, you should understand insurance limits and account categories, because it's in a bank isn't the whole story. And if you're holding investments at a brokerage, that's a different protection system. Securities Investor Protection Corporation protection is up to $500,000 per customer, including a $250,000 limit for cash and it's designed to protect customers if a brokerage firm fails and customer assets are missing, not to protect you from market losses. That distinction matters. It changes what safe means. So what does life look like at this flywheel stage? You're not checking your bank app 5 times a day. You're not scared of every headline. You can plan in years instead of paychecks. And ironically, you may feel less excitement, because once stability is normal, drama stops looking like entertainment. It looks like a threat to your peace. This is also where long-term tax planning starts to matter more, because you're stacking more dollars. For example, the Internal Revenue Service explains that Roth IRA contributions aren't deductible, and qualified distributions can be tax-free if requirements are met. Details that become more meaningful as account balances grow. You don't need to memorize every rule today. You do need to respect that, at this level, optimization isn't a luxury, it's a multiplier. Now for the one everyone wants to talk about. The $1 million options. $1 million is not a private jet. It's not a mansion. It's not, I do nothing forever. $1 million is options. And the simplest way to feel that is to translate it into income. A famous rule of thumb in retirement planning is the 4% rule, originally built from historical market data to estimate a starting withdrawal amount that could last around 30 years, adjusted for inflation. In that framework, $1 million points to about $40,000 in first-year spending, then adjusting over time. But it's a guideline, not a guarantee. Where did that idea come from? Financial advisor William P. Benjen published research suggesting that, for a 30-year horizon, a 4% inflation-adjusted initial withdrawal should be safe, based on the historical periods he studied. And more recent research groups still debate the safest starting percentage depending on valuations, bond yields, and assumptions, which is why some modern estimates land below 4% in certain environments. So what does your life look like at $1 million? If you have $1 million liquid and invested, not counting your home, you can take work decisions personally instead of desperately. You can scale back hours. You can walk away from a toxic job. You can buy time, which is the one thing no one can earn back. But there's a twist. The closer you get to $1 million, the more you realize the goal wasn't the number. It was the feeling of not being forced. And this is where people fall into 2 traps. Trap 1, thinking $1 million means you can stop learning. At this level, small mistakes can cost big money. Trap 2, thinking $1 million must be kept in one form. In reality, you'll probably have multiple layers: cash for near-term needs, diversified investments for growth, and maybe additional safety nets like insurance. If you want a quick reality anchor for how expenses can scale, the U.S. Bureau of Labor Statistics reports that average annual expenditures for U.S. consumer units in 2024 were $78,535, with wide variation by income.